1.4.3 Statement of Cash Flows. The Companies Act and IFRS requires that a statement of cash flows be included in the financial statements. This is a statement that clearly reflects the reasons for the changes in the cash situation of a business. Information regarding the liquidity of a business is of great importance to the users of annual financial statements because a cash shortage can cause a business to fail. By providing a statement of cash flows, the attention of users can be drawn to possible shortcomings in this respect. The following knowledge is necessary to understand the procedure that I explained below. The statement of cash flows consists of three main components. 1. Cash flow from operating activities. 2. Cash flow from investing activities. 3. Cash flow from financing activities. 1. Cash flow from operating activities. The first component of cash flow, namely cash flow from operating activities, consists of four elements. A. Cash from operating activities. B. Interest paid. C. Dividends paid. D. Tax paid. A. Cash from operating activities. The net profit calculated in the Statement of Comprehensive Income or income statement is not necessarily the amount representing the cash flow, seeing that it is polluted with adjustments, for example, accrued income, prepaid expenses, etc., as well as with items without any cash flow, for example, depreciation, etc. IFRS further requires that the payment to suppliers of funds, for example, interest on loans, the state, for example, income tax, and owners, for example, dividends, must be shown separately on the statement of cash flows. These principles and legal aspects are addressed by the following important calculations as first note to the statement of cash flows. The reconciliation of net profit before tax and cash generated from operations is a note that needs to be studied, and the format needs to be studied as well. So you're going to start with the profit before tax, then you're going to add adjustments relating to depreciation and interest paid. That will give you your profit from operations before changes in working capital. Then your changes in working capital will either be an increase or decrease in inventory, in debtors, or in creditors. I will explain later when it's a decrease and when it will be an increase, and then that gives you your cash generated from operations that goes to the face of your cash flow statement. Profit before taxation is used, seeing that it does not include income tax and dividends, and both these payments are subtracted separately on the face of the cash flow statement in accordance with IFRS. The amount for depreciation is added back to the profit because depreciation does not lead to a flow of cash. Interest paid is added back since IFRS requires that these payments to providers of funds be shown separately on the statement of cash flows as a deduction. It is important that only the amount of interest that was actually paid be added back and shown on the face of the statement of cash flows. If there were any adjustments relating to interest, it will be reflected in the change in working capital. The calculation of change in working capital is made through the following basic knowledge and derivations. Inventory. An increase in inventory means that inventory has been bought, which leads to a decrease in cash. This amount must be shown in brackets to indicate that it is a decrease in cash. A decrease in inventory means that inventory has been sold, and thus there is an increase in cash. Debtors. A decrease in debtors means that payments have been received from debtors, thus resulting in an increase in cash. An increase in debtors means the opposite, which results in a decrease in cash. The amount must be shown in brackets to indicate the decrease in cash. Creditors. A decrease in creditors means that creditors have been repaid, thus resulting in a decrease in cash. The amount is therefore shown in brackets. An increase in creditors means the opposite. In other words, an increase in cash. Example 6. Required. Use the given information to prepare the note of the reconciliation between net profit before taxation and cash generated from operations, Note 1, on 30 June 2025. Information. Information from the Statement of Financial Position of Review Limited on 30 June. A list of totals and balances is given for 2025 and 2024 regarding trade debtors, accrued income, income received in advance, trade creditors, accrued expenses, prepaid expenses, and trading inventory. Additional information on 30 June 2025. The net income before tax is calculated as 930,000 Rand. The following was considered in the calculation of net income: directors' fees, audit fees, depreciation on vehicles, depreciation on equipment, interest on your mortgage loan, interest on bank overdraft. Notes to the statement of cash flows. Reconciliation of net profit before tax and cash generated from operations. We are going to start with our profit before tax, and according to the information, it was 930,000 Rand. We're now going to add adjustments relating to depreciation. Our depreciation was 13,000 plus 12,000 Rand to give you a total of 25,000. And then our interest paid was 8,600 of the mortgage loan and 2,400 of our bank overdraft to give you 11,000. So if we add our depreciation and our interest paid together, our adjustment total will be 36,000. So profit from operations before changes in working capital will be 930,000 plus 36,000, which is 966,000 Rand. Changes in working capital. We are going to start with our trading inventory. In 2024, we had 114,000 Rand balance. In 2025, we had 144,000 Rand balance. So in other words, we had an increase in inventory. 144,000 minus 114,000 will then give us a decrease of 30,000 in brackets. So our inventory amount increased, therefore our cash flow decreases because we spent money buying inventory, so it's a cash outflow. Then we go to our debtors, trade debtors. In 2024 it was 285,000 Rand, and in 2025 it was 270,000 Rand. We must also consider the accrued income and the prepaid expenses, as that forms part of the trade and other debtors note in the balance sheet. So then you consider the 2024 accrued income of 12,000 and prepaid expenses of 13,000, and in 2025 the accrued income of 18,000 and the prepaid expenses of 2,000. So your total for 2024 will then be 310,000, and for 2025 will be 290,000. If you then work it out, you then get a decrease in debtors. $310,000 minus 290,000 will then give you 20,000 out of brackets. It's out of brackets because we've received money from debtors, so it's a cash inflow for the company. Then creditors, we are going to consider the trade creditors as well as income received in advance and accrued expenses for 2024 and 2025. Okay, so if you consider those amounts, then your trade creditors for 2024 is 250,000 and for 2025 is 205,000. So then we have a decrease in creditors. 250,000 minus 205,000 gives us 45,000 in brackets. So our change in working capital will then be a decrease of 55,000. Cash generated from operations then amounts to 911,000. B. Interest paid. According to IFRS requirements, payments to providers of capital must be shown separately on the face of the statement of cash flows. Any interest paid to banks must thus be subtracted separately. The statement of comprehensive income or income statement only shows the interest expense for the year and thus not necessarily the amount actually paid. It is thus important to calculate the interest actually paid to be able to add it back in the notes for the reconciliation of the net profit before tax and the cash generated from operations, as well as to deduct it separately on the face of the statement of cash flows. Remember that the interest that is payable or prepaid will be accounted for in the change in working capital. To calculate the interest actually paid to the bank, the interest on loan accounts can be reconstructed, or it can be calculated via logical calculation using information obtained from the statement of comprehensive income or income statements and the statement of financial position or balance sheet on the current and previous year. Example 7. Required. Use the given information and calculate the interest that was actually paid and which must be added back in the notes of the reconciliation of the net profit before tax and cash generated from operations, note 1, and which must be deducted on the face of the statement of cash flows on 30 June 2025. Information. Information from the statement of financial position or balance sheet on 30 June, our accrued interest on loan, 2024, 3,500 Rand, 2025, 1,600 Rand. Additional information on 30 June 2025, the net income before tax is calculated as 870,000 Rand. The following was considered in the calculation of net profit: interest on mortgage loan, 19,100 Rand. To calculate the interest paid, you can either complete the interest on loan accounts in the general ledger or do a basic maths calculation. So I'm first going to show you how to complete the interest on loan account. On the credit side of interest on loan account, we're going to say 2024 July the 1st. Accrued expenses, and the amount in the beginning of the year was 3,500. Then on the debit side, 2025 June the 30th, our bank is going to be our balancing figure, and that is the amount we paid in terms of interest. We also have accrued expenses. At the end of the year was 1,600. Then on the credit side, 2025 June, that's the end of our financial year, the 30th. the interest expense according to our income statement that gets closed off to the profit and loss account was 19,100 Rand. If we add the credit side together, so in other words, the credit expense of 3,500 and the profit and loss accounts of 19,100, we get a main total of 22,600. That must be the same as our debit side to make your ledger account balance. So our bank, which is our balancing figure, to calculate that, we're going to say 22,600 minus 1,600, and that gives you 21,000 Rand. And this is the amount that goes to your cash flow statement. So this is the one way you can calculate it by opening an interest on loan account in your general ledger, or we can do a basic calculation. We start with the amount owed at the start of the year, we add the expense for the year, and then we subtract the amount owed at the end of the year. So it will be 3,500 plus 19,100 minus 1,600 to give you 21,000 Rand that you paid during the year. C. Calculation of dividends paid. To calculate the dividends that were actually paid during the year to shareholders, the shareholders for dividends account must be constructed, or a logical calculation can be done using information obtained from the Statement of Comprehensive Income or income statement and the Statement of Financial Position or balance sheet of the current and previous year. The amount that is paid during the year to shareholders usually consists of the final dividend for the previous year plus the interim dividend of the current year. Example 8. Required. Use the given information and calculate the amount that was paid to shareholders relating to dividends during the financial year ending 30 June 2025. Information. Information from the Statement of Financial Position on 30 June. Shareholders for dividends in 2024, 67,000 Rand, 2025, 60,000 Rand. Additional information on 30 June 2025. The net income before tax is calculated as 870,000 Rand. The total dividend declared during the accounting period ending on 30 June 2025 amounts to 143,000 Rand. It includes the interim and the final dividends. So the shareholders for dividends ledger account, on the credit side, we are going to write 2024 July the 1st. It's going to be our opening balance of 67,000. Then on 2025 June the 30th, we are going to write ordinary share dividends. And that was 143,000 according to the additional information given. So our subtotal will then be 210,000 Rand. That will be the same as our debit side to make the ledger account balance. On 2025 June the 30th, on the debit side, our bank will once again be our balancing figure, and that is the amount that we paid over as part of dividends. And our closing balance, according to the information, was 60,000. So 210,000 minus 60,000 will give you 150,000 to make it balance. Or a basic calculation can be completed where we take the previous year's final dividends, we add the year's total dividends, and we minus this year's final dividends. So So it's going to be the 67,000 Rand plus the 143,000 minus the 60,000 to give you 150,000 Rand paid towards dividends. The balancing figure is the amount actually paid to the shareholders in relation to the dividends during the year and represents a decrease in cash, which is shown in brackets on the face of the statement of cash flows. C. Calculation of income tax paid. The amount that was actually paid over to SARS relating to income tax can be calculated by reconstructing the SARS income tax account, or a logical calculation can be done using information obtained from the Statement of Comprehensive Income or income statement and the Statement of Financial Position or balance sheet of the current and previous year. Example 9. Required. Use the given information and calculate the amount that was paid over to SARS relating to income tax during the financial year ending 30 June 2025. Information from the Statement of Financial Position or balance sheet on 30 June, SARS income tax, in 2024 a debit balance of 5,700 Rand, in 2025 a credit balance of 6,800 Rand. Additional information on 30 June 2025, the net income before tax is calculated as 870,000 Rand. The company tax is calculated at 28% of the net income. SARS income tax, our opening balance 2024, July the 1st. We have our balance brought forward of 5,700 Rand. Then on 2025 July the 30th, our bank will be our balancing figure, and that will represent the amount paid. And then our balance carried forward for the next year is 6,800 Rand. On the credit side, 2025 June the 30th, our income tax amount paid over to SARS, according to the information given, they said 28% of the net income is our company tax. So what is 870,000 times 28%? That gives you 243,600 Rand. So we then total our ledger account. The credit side is 243,600, so the debit side must also be 243,600. So our bank, which is our balancing figure, we're going to say 243,600 minus 6,800 and minus 5,700, and that will give you 231,100 Rand. Or you can do a basic calculation. You minus the amount received at the beginning of the year. You add your income tax for the year, and you minus the amount owed at the end of the year. So negative 5,700 plus 243,600 minus 6,800 gives you 231,100 Rand unpaid to SARS during the year. The balancing figure is the amount actually paid to SARS during the year and represents a decrease in cash, which is shown in brackets on the face of the statement of cash flows.